Hi guys, welcome back to the channel. My name is Brad. This is the Firefighter's Financial Toolbox. Well, the S&P 500 is almost back to a new all-time high, which is crazy to think after how we started this year off, you guys. Look at today, we're at 3,372. We're almost completely back to the all-time high back in February. What does that mean for us? Well, first of all, is the S&P really as healthy? Is it doing really as well as it looks like it is? One thing we have to think about is how the S&P 500 is made up. Remember, it's a market capitalization based index. So what does that mean? That means the 5 biggest companies make up 20%. Microsoft, Apple, Amazon, Google, and Facebook. So the way it works in the S&P 500 is it's calculated by multiplying the number of shares issued by a stock price. A company that has a market cap of 100 billion or more receives 10 times the representation as a company that has a market capitalization of 10 billion. The bigger the company, the bigger the portion of the index they make up. Now, we know the S&P 500 is the 500 largest companies in the US. But they're not equally weighted, you guys. Is it too high? Is it time to get out? We often hear people say, I don't want to buy in because the market's too high right now. I want to wait for a pullback. So I decided to take a look back into history and see what it looked like back in the day. So if we look at some milestones in the S&P 500, first of all, the S&P 500 started in January of 1950. Actually, the first close date was January 3rd, 1950. The index closed at 16.66. Now, it took 18 years for the index to climb above 100 points. That closed on June 4th, 1968 at 100.38. Fast forward 19 years to what they called the Black Monday. Black Monday was the biggest one-day loss in the S&P 500 ever. It lost 20.4% of its value, you guys. It fell from a high that day of 282 points all the way down to 225.06. Fast forward a short 8 years later, and now it's doubled and it's closing for the first time over 500. Here's the funny thing, from March of 1995 to February of 1998, it doubled again, you guys, and closed for the very first time over 1,000 on February 2nd, 1998 at 1,001.27. After that, we climbed up to this thing they called the dot-com bubble. Maybe you were too young to remember that. I remember the excitement. Pretty much anything that had .com in the name went public overnight. Now, a lot of those companies are now dead and defunct, but it was pretty exciting at the time. And it climbed to a high on March 24th, 2000, where the S&P 500 hit 1,552.87. And then the crash came, as it often does. Built up, built up, built up, fell down. Now, the next time it crossed a new high was in 2007. On October 9th, 2007, the index closed at a new record high of 1,565. And then along came another crisis. Maybe you remember it was called the financial crisis. Or as we like to look back on it, we call it the Great Recession. You guys, that was a scary time. We almost went into a global depression. The banking system almost collapsed. It was horrible. But what happened? It recovered. And it actually recovered pretty fast. The next high we had was March 2013, and we got back up to 1,576. And it's been steadily climbing since then. And it climbed all the way up until February 19th of this year. I don't know if you guys remember February 19th, we actually hit 3,386.15. And then we had the pandemic crash, where we lost about 40% of the S&P 500. And now here we are. 6 months later, you guys, not even 6 months, 5 months later, and we're almost back to record highs. What does that mean for us? What should we do? What happens if you missed out on some of the best days in the stock market? So I decided to take a look at that. So here's a target. Now this is a couple years old, you guys, because a lot of they always look back on history. So if you were fully invested from January of 1999 through December of 2018, with $10,000, you would have made, even with the 2 crashes in there, you would have made an overall 5.62%. If you had missed 10 best days in that 20-year period, you would have only got 2.01%. And if you had missed 20 of the best days, you would actually be negative 0.33%. That's a pretty scary thought, because you know what? None of us are that smart. We may think we know where the stock market's going. We may even think we know what it's going to do today. Hey, it looks like it's going to go down. I'm going to sell a bunch and then I'll buy it back tomorrow. Market timing doesn't work, you guys. The best option is to continually invest into the stock market. Don't worry about what it's doing today, what it's doing in the next month. Just continually buy more. It appreciates over time. Remember, like I always say, keep a long-term investing attitude. Keep putting money in, and it's going to grow. All right, you guys, I hope you got something out of this. If you did, do me a favor, drop me a like. If you're not already subscribed, you guys, subscribe to the channel. Get the notifications, let you know every time I make a new video. I try to make a couple a week. All right, we'll see ya. Thanks.